Good morning, everyone. Welcome to our 2020 economic forecast. I am Ben Herrera, your 2020 EVAR president. We're excited to have Jordan with us this morning. I hope everybody can see him okay, and hope everyone is staying healthy and clean at home. Before we get started, I just want to give Jordan a brief introduction. Jordan Levine is the Deputy Chief Economist at the California Association of Realtors, which we all know is a statewide trade organization of real estate professionals with more than 190,000 members. Jordan helps to oversee all housing market research at C.A.R., including market statistics, survey research, industry trends, and policy analysis for C.A.R.'s legislative and governmental affairs efforts. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. Prior to joining C.A.R., Jordan worked in consulting as an economist and director of economic research, where he oversaw all research analysis on California's economy and housing market, and regularly spoke to trade groups, public officials, businesses, and the media. So let's give Jordan a nice virtual warm welcome. Welcome, Jordan.
Hey, Ben, thank you so much for having me, and thanks to Annette for inviting me to be here today. I'm going to share my screen so that you don't have to look at my face, even though I know that's the big draw probably. No, I'm happy to be here talking about the economy because there's lots happening and lots of uncertainty. So my goal here is to try and cut through all of the rhetoric and headlines and give you the information as we see it today. I always start by going through the fundamentals first, and I think it's important to remember where we were before this whole thing kicked off because two reasons. One is that it's important to distinguish this from like a 2008, 9, 10, where this is largely the result of an external shock, whereas back then we had deep fundamental issues brewing under the surface of the economy that then took several years to unwind and play themselves out in the shape of the great, recession that we had during that time. This time around, we were on a strong footing economically, and I'll show you some of the pre-outbreak or pre-COVID data, however you want to characterize that. And although, we weren't growing at a kind of blockbuster pace, the economy was in relatively good shape from a growth standpoint, and more importantly, from a fundamental standpoint. And so I think that that's important to distinguish what we saw last time, and it seems like that bears repeating based on some of the survey research that I'll share with you in a moment. But I also think it's helpful in thinking about the shape of the eventual recovery, right? Because again, this is what is hopefully a temporary phenomenon that is happening to what was otherwise a relatively healthy economy. And that should help us when it comes time to begin the upward slog. It's not to say that it's going to insulate us from any of the negative impacts. So I will spend some time going through just what we do know about the impacts of COVID-19, how we're seeing that play out across the market. And the truth is that, there's a lot of uncertainty out there in terms of the forecast. Leslie actually has a way better title for her slide than I do, but she's calling all the range of forecasts that I'll show you later like gussied up guesses, which I think is, I'm going to have to steal that one for my next one because that's really where we're at. There's a lot of uncertainty, but the one thing that is fairly consistent is that we do expect negative impacts both in the general economy, and we're already seeing that in terms of consumer spending, job losses, new claims for unemployment for sure. So I'll walk you through kind of all of those things and why we really do need to be prepared for at least another month or two of belt tightening based on all of the data that we see coming in so far. There's, again, even though there is a lot of uncertainty, I will share the data that we do have and the kind of framework that we're using to try and gauge just exactly how deep and how wide this downturn will be. If you just fast forward back a month ago at the beginning of, well, I guess it's more than a month now. It feels like, I don't know what day it is anymore, but at the beginning of March, we were having this conversation like, wow, this thing seems like it could be pretty bad, but look at how low rates are, right? And so we were kind of trying to assess how much low rates were going to offset in terms of any, potential economic consequences. And what we know now is that the economic consequences are going to, far outweigh the benefits of low rates. But I do think that the low rates are going to be a feature for at least the medium term, right? And so I think that for that reason and many other reasons, housing could be one of the bright spots during the recovery. And so I want to not just talk about the short run forecast and outlooks that are truth be told, fairly scary, but also to talk about, again, that recovery process where I think that housing could be, again, one of the bright spots, or potentially even help us to get back onto a normal trajectory. And then I'll just leave you with the slide that kind of highlights all of the various resources that C.A.R. has available for you. And I'm just doing, a tiny bit by coming out and speaking to you guys about the market, but my colleagues have really stepped up to the plate at work. And this is why I got into the real estate game and out of consulting in the first place. And I feel like, again, just super proud for all the stuff that we have available. So let's go through the pre-outbreak economy for a minute, again, because I think it's important to both distinguish where we were back in 2008 and also to highlight what a recovery might eventually look like. So here I'm showing you real GDP growth. This is the number that people talk about when they say economic growth in general terms. They're really talking about GDP, which is just the measure essentially of all the revenue and income being generated in a particular quarter across the whole economy. It's one of these nerdy esoteric terms, but really it's a simple concept, and it's the measure of our productive capacity as proxied by the dollar figures that go into either wages or, again, business revenue. And what you can see here is that we continued to grow right through the end of 2019, keeping in mind, again, that most economic data is backward looking. But there was no signs of a deceleration in terms of the pace of our economy. It wasn't a pace to write home about, certainly at about 2 to 2.5%, but it shows that the economy was still growing at a pretty solid clip. And we saw very similar things, not just in terms of the dollars and cents of the economy, right? But we also saw this playing out in the labor markets. In fact, if you look to the far right-hand side of this chart, depending on where the video feed is showing up, you can hopefully see that the far right-hand side actually shows job growth ramping up a bit, right? So we weren't just maintaining growth, but actually 2020 was shaping up to be a pretty solid year with jobs and revenues starting to ramp up. And that was true both in the nation overall, but we were also seeing that right here in California. And so again, we were on this kind of solid economic footing, and in fact, on pace to have a year that was even better than it was in 2019. And the job growth is really remarkable in the context of an economy that was basically at all-time low levels for unemployment, right? In California and in the nation overall, we were down either in the high threes or the low 4% range, depending on what specific metros, but virtually everybody who wanted a job had a job, right, as of February, and the unemployment that we saw was, structural in nature. There was just some residual unemployment because we always have some mismatch between, the jobs that we have available and the skills of the people who are still on the sidelines of the economy, and there's always going to be some level where those two things don't match up, and we're going to have some what economists call structural unemployment. But if you look back historically, at least in California, where we can only get good data going back to the mid 1970s, we were certainly at the lowest levels of unemployment that we have seen in modern history. And this is why the housing market was so tight, just to kind of remind us about the Great Recession and the subsequent recovery. We did lose between 2007 and 2010 about 1.3 million jobs from the California economy. But if you look at this chart here, what you can see is that by 2014, the summer of 2014, we had already added back all 1.3 million of those jobs. And so basically what that means is that every single month almost for the last 6 years, pretty much consecutively, has been a new all-time high level for non-farm employment in California, to the extent that by February we had 2.1 million more jobs than we had ever had before, including at the height of that last expansion back in 2007. And so in some ways our biggest strength was our biggest weakness, because all this great job growth was really the thing that was driving the lack of inventory that we had out in the housing market. Because, and I didn't bring these figures with me, but rest assured that we did not build 2.1 million new homes for all these new jobs that we've created. And so again, that was why inventory was so tight, why affordability and home ownership couldn't rebound, right? But on the flip side, for those of us who were able to get our foot on the property ladder since 2012, it's also been the main reason why we've accumulated so much equity during this period of time. And so it's a good problem to have, that the economy is growing faster than the housing stock. But, if we were in normal times, I'd be harping on how we really need to start getting our act together on new construction. But point being for this one is that, the fundamentals of the economy were strong. If you look at consumer confidence, you can see that we weren't at all-time high low levels that we had hit at the peak of the dot-com era, but consumers were feeling pretty good about the state of affairs. And I'm just giving you a little bit more of a zoomed in version of that on the right, so that you can see over the last 3 years, consumers have maintained a relatively high level of confidence. But it wasn't just their sentiments that they were feeling good, right? This is also backed up by their actions. And so what I'm showing you here is retail sales figures, and they look very similar to the story that I was just walking you through on the jobs front, right? Where actually spending came back a little bit quicker than the jobs, which makes sense, right? You, as a business owner, you want to see your income ticking up before you make those big investments back into labor. But pretty much since 2013, again, consumer spending had been setting a new all-time high virtually every single month that time went on. And if you look on the right-hand side here, then you can see in terms of growth rates, same story as on the jobs front, right? Where we see not only maintaining a fairly healthy pace of growth, but we were actually seeing the tail end ramp up in terms of consumer spending. So again, just kind of underscoring this idea that not only was 2020 shaping up to be okay, it was actually ramping up to be even better again than what we had during 2019. And this is probably one of the biggest distinctions between now and 2008 is that the fundamentals in terms of the household balance sheet were in much better shape today than they were back then. And so what I'm showing you here is both debt and broader financial obligations, including things like rent, et cetera, both measured as a percentage of current income, right? And so you can see that, yes, partly because rates are so low, but mostly because we have such a massive deleveraging in the wake of the Great Recession, that we don't have this household that is overburdened or over leveraged with financial obligations or debt payments. In fact, even if you strip away mortgages, and we know not enough folks have been able to get back into housing this time around, as evidenced by the lackluster growth in home ownership. But even when you strip out the mortgages and just look at auto, credit card, student loan debt, et cetera, we're not just at pre-2008 levels for debt and financial obligations. We're actually at the lowest levels in terms of the lowest burden as a share of current income for debt and financial obligations that we've seen in several decades, right? So not only were they feeling good, were they employed, but their balance sheets were in really good shape, and that, for better or worse, and it was a very painful process. But one of the few silver linings of the Great Recession of 2008, 9, and 10 was the deleveraging that it caused. We saw savings rates start to come back up from zero, where people were essentially just not saving, to as well as bringing down those debt levels, be they via bankruptcy or foreclosure. Again, a very painful process. But in the wake of that, we have households that have balance sheets that are fundamentally in much better shape than they were back in the last downturn, right? And so I think that especially as we look at some of the survey data, which we just got back this morning, actually, and I was up early putting it in the slide deck for you all. But I think that there's a lot of reasons to harp on how this time is different, because for a lot of consumers out there, especially ones who are thinking about getting into the housing market for the first time, there's a lot of that emotional and psychological scar tissue left over, where for them, they only know one kind of recession, the kind that is housing led, and the kind that comes with 30, 40, 50, 60% reductions in home prices. And I think that it can't be overstated that every recession is different, and we'll talk about why that's going to create some challenges in the marketplace for housing here in California moving forward. But for the most part, we were in good shape fundamentally, and things were looking good, and that should help us when we get around to the recovery process. That being said, there are a lot of reasons why we really need to make sure that we're taking this very seriously and being prepared for kind of, not Armageddon certainly, but definitely a period of really belt tightening, I think is a good way to characterize it for at least the next couple of months. And so I want to walk you through some of the reasons why, right? And one of the big ones is in terms of the financial markets, right? And I know like oil is trading negative right now. It's a great time to start an oil conglomerate, I guess, since they're basically giving it away on the futures markets for free. If you can get a tanker and show up and be holding those futures contracts, then you could potentially build a little oil empire right now. But the financial markets have basically given back about 2.5 to 3 years worth of gains, depending on what day or even what time of the day you're looking at it. And that obviously has the twofold impact of impacting people's wealth, right, which is going to affect us in the housing market in general, in the desert in particular, right, where we have a lot of second home and retirement home purchases that are oftentimes being funded by wealth that's generated in the stock market and elsewhere. And so, the one thing that we do know pretty certainly as economists is that when the typical U.S. household gets poorer, that it's bad for economic growth, right? So what I'm showing you here is real net worth per capita basis, and these are annual growth rates in real net worth. So we've stripped away inflation and then divided out all the net worth on a per capita basis. And what you can see is that this is one of the few indicators going back historically, and these gray bars are the periods of recession that we've had in the U.S. economy. But almost every time, right, it's batting almost 1,000 in terms of being able to predict a recession. And again, this data is backward looking, so we only have this information through the end of 2019. But given what we've seen happen in the stock markets, it's safe to assume that when we do eventually get this data for the first and second quarters, sometime like 9 to 12 months from now, when it will be of no good to us, but it is helpful in giving us a framework on how to think through this, is that these numbers probably will dip negative, and that does suggest that we will be in an economic recession, and obviously the wealth impacts on the spending side as well. But the other reason why this matters is because here I'm showing you GDP growth, but we also have the consumer confidence element to think about as well when it comes to financial markets, right? And so when you look at this exact same GDP chart that I showed you earlier, Here, I'm showing you the same numbers, but all I've done is I've subdivided it up into how much of that growth was due to growth by consumers and how much was due to every other part of our economy, like business investment, non-residential and residential construction, government spending, inventory accumulation, international trade. And what you can see is that these dark blue shaded bits are responsible for virtually all of the growth. In fact, in many quarters, we had everything else going south, and consumers were the only thing kind of propping up the economy and keeping us at those kind of 2% growth rates. And so in some ways we had all of our economic eggs in a single basket, and that's the basket that is poised to be the most impacted because people are, again, poorer. We have the consumer confidence element, right? We've got the shelter in place where even if you are in decent economic shape still and have your job and are continuing to make income, you're not able to get out there and spend. And then of course we have the impacts associated with lots of folks having lost their jobs over the last month. And so when you take away the consumer spending, we don't have much to fall back on, which is why the projections for the depth of this thing are so deep and in some ways so scary to look at. And of course, we've already started to see this play out in the March data. So we had the biggest single month retrenchment in since the 2008 financial crisis in terms of consumer confidence, consumer sentiment. And I think that is still the tip of the iceberg. And that's going to be the case for a lot of these indicators where really only from about the 16th of March onward were really impacted by the shelter in place. And this indicator in particular is taken around the 20th of the month. And so I think that a lot's changed since then. And we'll continue to see this go down as the months progress, but it's already playing a role in the spending number. So these are annualized rates of monthly growth. So we took the month-to-month growth in retail sales and extrapolated that out to what it would look like on an annualized basis. And we've had the single largest decline in 1 month decline in consumer spending in recorded history, right? So this is, again, impacting us right in the pocketbook, if you will, of consumer spending, which again was the only source of economic growth that we really had to speak of going through this period. And that's why it is going to be really hard to get through, at least for the next couple of months, because businesses have really been hit hard with reduced spending. And you can see that on just a straight up monthly basis from February to March, the nominal amount, non-annualized amount of retail sales were down by 8.7% for a single month. And we're usually measuring this stuff in basis points, right? Like 20 and 30 basis point increases are big annualized moves. And you can see that actually it would have been a lot worse if we weren't just able, to still buy basically groceries and just household goods, but every other part of the economy was down. And that's why it's going to be so widespread, especially across local economies, because again, keep in mind, these are month-to-month changes. And so for things like furniture, clothing, and accessories, there was literally half as much money spent in those categories as there was the previous month. So if we annualize those categories up, right, for furniture, for restaurants, we're talking about thousands of percent worth of decline. And so this is going to play out across every aspect of our local economy. I brought tons of charts just to illustrate this, and I won't beat them to death, but I just wanted you to see how dramatic the declines are, point number one, and how widespread this is across almost every aspect of our local economies, including theaters, going to see shows, and you guys will have all these. I'll send these slides to Annette so that you can use them, but, basketball attendance, and also, all of the consequent business that goes along with sporting events like restaurant and bar attendance before and after, hotels, advertising revenue on local TV stations. This has real economic consequences, in addition to just not being able to watch watch sports, but also, you see it in terms of, restaurants who are really bearing the brunt of this. And I joked that we went and picked up tacos the other day, and they were so grateful just to have a takeout order because they are, their business is just being so dramatically impacted. We have seen some grocery delivery ramp back up, but if you think about restaurant delivery or even just takeout, it hasn't shown the response. And unfortunately, that accounts for the lion's share of the food service workforce, which means that, we're still experiencing the lion's share of the negative consequences of this thing. Hotels, which again, we have a big tourist component, right, in the desert where people are coming out to spend money and do all of that stuff. And that's a critical part of the local economy. Well, hotels are down, the airports are down, and obviously all of the spending that goes along with tourism is bearing that as well. And so what it all boils down to, really, from an economic standpoint, and Moody's went through and crunched the numbers graciously for us to be able to estimate how much of our GDP are we losing on a daily basis. And so we looked at all of the sectors that are non-essential, and they basically superimpose that over our GDP numbers and divided it out on a daily basis. And so what they basically came to the conclusion was that of our $8.8 billion GDP that we generate every single day to add up to our annual GDP number, about 31% of that is exposed to, or is just essentially being lost because of the shelter in place and the broader economic consequences, to the tune of about $2.8 billion a day in lost GDP. And remember our earlier definition of what GDP is: basically incomes and business revenues, right? And so that is real money that's going to then have its own ripple effects and consequences, and what we call multiplier effects that will snowball through the rest of the economy, right? Because $2.8 billion worth of missed income or business revenue or what have you means, lost rent payments and, missed auto payments and et cetera, et cetera. And so you could see that the whole chain of events will be impacted to the tune of about, we've already lost about $60 billion. And we actually pulled this, I think, mid last week. So you could see that adds up to real money, and why we really need to take this very seriously and to be prepared for, again, this period of belt tightening. And this is kind of the less nerdy, esoteric way to think about this, because this is where the rubber meets the road on all of those various indicators, right? Is that it all shows up in the form of unemployment. And what you can see here is that over the last 4 weeks, we've seen more than 22 million people file for unemployment. And that is just, you can barely even see these bars over here on the right hand side because it's so unprecedented. They're so high up. It also makes previous periods of unemployment just look like a cloudy day when you're trying to have a picnic or something like that. And so when you put it into perspective, right, during the 2008 financial crisis, over a 2+ year period, we saw basically 37 million people file for unemployment, right? And that took about a little over 2 years. And already in just 4 weeks, we've seen more than half that number file for unemployment in, relative to that period, which was basically the biggest run up in unemployment that we had seen since the Great Depression. And so this, again, is where all those effects are going to come out of. When we talk about the housing market, we always say when people are working and earning money, that's good for housing. But unfortunately, the reverse of that is true, right? So when we have fewer people working and making money, it makes it both directly impactful for housing, for ownership housing, because you don't have as many people out there buying, but also indirectly because it affects the rental side of the market as well, which undermines the value of property in California if it persists for a long time. And of course, as realtors, we saw this ramp up early. I didn't update this slide, but we just got new numbers in this morning on the same survey that we've been talking to realtors every single week for the past 7 weeks, and just spoke to them again over the weekend. And our survey ended last night at 5 p.m. But what you can see is that we went from basically a situation where at the beginning of March, only about half of realtors expected the coronavirus or COVID-19 to negatively impact their business. But over the next subsequent 2 weeks, that grew to virtually 100%. And even though it was down from 97% to 95 in the data that just came in this morning, we're still talking about basically a plurality of realtors expecting this to have negative consequences for them. And this is really why, right? We're seeing buyers pull back, both because they have cold feet, but also because of the economic consequences associated with job losses, and also frictions in the mortgage market that make it impossible for them to move forward, such that almost half of realtors have now had a buyer that has wanted to withdraw an offer due to coronavirus. Same thing on the sell side, right? This is the numbers from yesterday show that 57% of realtors have actually seen a seller not just get those generalized cold feet, but actually pull that house down off of the MLS. Interestingly, the amount of new listings is falling by more than the amount of sales or the amount that buyers have pulled back. And so the market's still relatively tight, but we haven't seen this big implosion in terms of overall actives, right? So these are new actives that aren't coming on to the market necessarily, but overall inventory levels have not plummeted. That being said, it's tough times out there. And again, we need to be prepared to A, be on our A game, and B, have to really work, because our clients need us more than ever. Last week, 31% of realtors, or over the weekend, 31% of realtors had said that they've actually had a transaction fall out of escrow, and that's up a little bit from where it was the previous week. So again, as these job losses mount and credit dries up, or credit availability dries up, or they're raising standards and things like that, we're seeing actually more transactions fall out. And here's the big thing that I was mentioning earlier, that we have seen pretty consistently. And again, this is why it's important for us to distinguish this from 2008, because in the minds of the buyers, for the last 2 weeks consistently, realtors are reporting that buyers are, the lion's share of buyers at 90% are expecting prices to go down now, right? They equate recessions with double-digit declines in home prices, and they are trying to claw some of that back. We've actually had, and the numbers are still relatively small, but last week was this most recent weekend, ending yesterday, is the first time we've asked this question, but 30% are reporting that they've actually had buyers in escrow trying to renegotiate the price down because of that kind of extrapolation of last time around, right? And they think that this just surely has to come with lower home prices. And I think that this is going to be a challenge for us as real estate practitioners, because sellers are not on the same page with that. In fact, we asked the same question on the sell side: have you seen sellers who are willing to slash price in order to attract buyers? And only 33% said yes, that they've had sellers who have lowered price. And in fact, if you look at the MLS data, which I'm showing you on the right-hand side, and I just divide it up, this is like a pie chart that we show over time, right? So it's just two slices of the pie. Is it discounted, or is it at original price? And what you can see is that there has been no surge in the dark blue bars, right? We don't see those dark blue bars getting taller and taller, meaning that we don't see the percentage of active listings where sellers have reduced price increasing very much at all. And I think that the phenomenon that we're seeing, and I'll show you the MLS data here in a second, is that sellers view this as a temporary deal, right? And so they're more willing to just take the property down for, a couple of months and then put it back down, rather than doing the kind of fire sale price cuts that maybe the buyers are hoping for in that data that I showed you. And so I think that that's going to be incredibly challenging for us, and we're going to have to kind of walk that fine line with the buyers and sellers, that it isn't a 2008. Maybe we can get a little bit of concessions, but when you look at the net inventory levels, the market is still relatively tight. There's fewer buyers out there, but there's also fewer choices for the people who do want to make a move. And so it's not clear to me that, and again, just hearkening back to the earlier slides, but we don't have these deep fundamentals where there's this huge pile of bad credit from all the ninja loans and stuff like that, where we're going to see this kind of full scale pullback from housing. If you can make your payment and you still have your job, then you'll just hang on to that house, right? And so I think that for those reasons, the market will remain challenging. You can see here, we've been going in, not just in surveying realtors every week, but we've actually been going into every single MLS in the state and querying the data so that we can get a handle on what's happening. I've aggregated that up for you on a weekly basis here. But two things jump out when we see closed sales, right? The March numbers, which we released, and I'll show you those in a second, really should be interpreted with some caution. You can see that even through the 21st of March here, closed sales in Southern California held up relatively well. And that's because we were still burning off the pendings and all the escrows that we had built up in January and February. And we were able to continue those through the pipeline right up through the shelter in place order. But as you get into these first couple of weeks of April, what you can see is that the numbers that we've been seeing and reporting on in terms of pending sales being down substantially are starting to play themselves out in terms of the closed transactions. And so I think that you can see here in terms of the overall numbers, right, that sales are down something on the order of about 30-ish% in Southern California, but I think that we can expect those to, accelerate in the coming months. So we do need to be prepared for, to keep those belts pretty tight, right? So you can just now see that we're just finally getting into the double digits in terms of sales declines in Southern California, but that's true pretty much across the state as well. And we're seeing that kind of same trend even in our local MLS data, right? So again, right through about the 20th or so, we were maintaining, but you do see in these first couple of weeks of April that the sales numbers on a daily basis are starting to trend down from basically about 25 or so closed transactions every single day to last week, there was about 15 or so average per day. And just yesterday, you can see the Monday morning close was lower than a lot of the previous Mondays we've seen. And so again, these chickens that we've seen in the pending side are finally coming home to roost on the closed sales. And so when you look at our overall statewide press release number that showed sales down 6.1% on a year-to-year basis in March is really probably just the tip of the iceberg, because again, we had all those pendings still working through the pipeline the first half of the month, and which is why we expect the declines to be more severe in April and into May. And part of that is because of what we see happening on the listing side. So you can see that listings were actually down even more than what we see on the closed sale side, right? They responded much more immediately to the shelter in place numbers. And so in Southern California, it's not quite a 50% decline, but we're really close to having cut the number of new listings coming on to the market every week in half, right? And that's true virtually across the state, basically same orders of magnitude. And again, I bring the local data with me because I want you to know how this is playing out in your market. But really, the issues are macro issues at this point, which is why our data looks so similar to what we see in the Bay Area and the statewide numbers at large, because again, these are just broad macro impacts that are affecting everybody in the same ways, more or less. The good news, and maybe I should back up a sec though, is to say that although we've seen much stronger impacts on new listings and they happen much more rapidly, we do see some glimmers of hope that kind of we have been basically bouncing around a bottom. And I don't want to call it a bottom or say that we're at the bottom yet. I think it's still too early to tell, but it is encouraging to look at these last 3 weeks worth of new listings to show that, yes, they were down by about 50% almost overnight, but that we found some stability around this new much reduced level. And that is encouraging, just in the sense that we don't see these declines just continuing to accelerate further downward. And you can see that actually in Southern California, we actually had a modest increase in active listings, and that played out in the Bay Area and the Central Valley as well, such that in California, we had about an 8.7% rebound in the number of new listings. Still too early to call it a bottom, but it is encouraging that it seems like this immediate hit was baked in right off the bat into the new listings, and also, as you'll see in a second, into the pendings, but that we do seem to be finding some stasis there, and business is still getting done. In fact, we're still holding up relatively well on the new listings front. We had 19 go up on Friday, and so there is still stuff that's out there. But when you look at pending, again, it suggests that we should be prepared to keep belts tight. We still see that stability kind of getting built into the most recent couple of weeks. But pendings were down a little bit more than 50%, actually, almost by 60%. And that means that, again, the prospects, those are our closed sales for, May and later in April and May and potentially even into June. So, again, need to take this very seriously because, the closed sales are not shaping up. And you see the same thing locally. I don't want to sound like a broken record, but we went from about 30 or so homes going pending every single day pre-crisis locally, and now we're down to something on the order of about 15 to 20 depending on the day. But again, see that same kind of stability around this new bottom that's about 50% of the pre-outbreak numbers. Just a little bit more evidence that we could potentially be finding a bottom. And again, I don't want to say that we are at bottom, but what we saw in the mortgage applications number, and these are just purchase applications, is that we had these kind of big 50 and 60% declines from where we were at this time last year. But actually, over the last week and a half, we actually have seen some stability in purchase applications here in California as well. So again, these are encouraging signs. We don't want to pop the champagne corks yet, certainly. And I do think that regardless of whether we find bottom or not, the next 2 months are going to be challenging for us. But these are at least positive signs that maybe that pace of decline is slowing. And perhaps more importantly, the one everybody wants to know about is on the price front. And we haven't seen a lot of movement in prices. And again, I think that's because for a seller, they'd rather just take their house down than make these steep cuts. And so when you look at price on a per square foot basis, they haven't really budged much at all. If you convert those numbers into percentages, that's about a 2.9% decline in prices in Southern California as a whole. And that was through last week, Bay Area a little bit more, but definitely nothing to suggest these kind of fire sales that buyers are looking at. And so again, I think we're going to be continuing to struggle with this kind of mismatch between expectations of buyers who think that recessions equal 20 to 30% price cuts, and sellers who see this as temporary and I'll just sell it in the fall and or next year even, and there's no need for me to slash prices at this point. In fact, prices were still going up by 8.3% in March, and that was even with the second half of the month being baked in there. So there's just not a lot of evidence that these price cuts are coming down the pike. And in fact, when you look at, I didn't update my header, but these are actually East Valley median prices. I just didn't update the header, but you can see that on the per square foot numbers, there's virtually no movement, right? We're still basically $224 a foot, the way that we were before the crisis. And in fact, if you look at the median price of new listings coming onto the market, they've actually gone up from $399 to $405. That's like statistically insignificant, but definitely nothing in there to suggest major price cuts. And I'm showing you the same chart that I showed you statewide on the right-hand side, where the percentage of active listings here in the East Valley, we have not seen that number skyrocket. We basically have that same 28 to 30% of actives that have reduced price that we had, even before the shelter in place. And so, that's good news, but I do think it's going to be challenging for us as practitioners to kind of overcome and have to grapple with that gap between buyer expectations who are like, let's get another, 30 grand back or 50 grand. Or we did one and we heard anecdotally in the Bay Area that, some of these big luxury properties, somebody wanted to get 500 grand back or else they weren't going to close and remove contingencies, et cetera, et cetera. And I just don't think that, again, the sellers are there yet because they still perceive this as a temporary deal. So that's kind of the bad news. I do think that the good news is that when we do get around to this eventual recovery, and it will eventually happen, it's just a question of when, not if, that real estate is poised to do really well. We're still in this kind of historically low rate environment. And I think you guys all remember my joke about my dad always bragging about his 12.5% mortgage interest rate. So this is going to be a real feather in the cap for the economy, right? Just in terms of rebounding, but also for housing in particular, especially in a state like ours where mortgage rates, even little changes in mortgage rates make huge difference for monthly payments. I think we could even see rates go lower. If you look at where 10-year treasuries are, we should be seeing mortgage rates that are below 3% right now based on the historic spread. And there's all kinds of goofy stuff happening in the financial markets right now or in the mortgage market, frictions that we could talk about that are preventing those rates from filtering all the way through to consumers. But it's not unthinkable that we could, at some point in the future, see mortgage rates that are even below 3%. And so again, that will give housing a nice kick in the pants. I also think that to the extent that we think the stock market is going to continue to be volatile, and I do believe that that is the case, it's going to make housing look not just attractive in absolute terms because it's a good investment, et cetera, but in relative terms when people are worried about continuing to lose money in financial markets. And of course, with all the amount of time that we're all spending in our house, I think that your housing is going to be even more important to you moving forward than maybe in the past. And I think places like the desert where people can go out and get a nicer quality of life and a better home now that their companies have realized they don't need to force everyone to commute to the office. Areas like that, areas like ours that we're talking about here today are poised to do exceptionally well. Same with the area that I'm broadcasting from in the Central Coast, rather in San Luis Obispo. People don't move up here because there's not a lot of jobs. But if you don't have to commute into to LA every day, then it opens up a lot more options and the amount of quality that you get for the same amount of money. And that I know that's true in the desert as well. And so, just to remind us that housing was on a good footing before we came into this with both sales and prices accelerating. So the fundamentals for housing were there. This is an external shock that happened to what was otherwise a relatively healthy environment. If you ask me what my forecast is, this is the point where I start scratching my head and can't give you a specific number because there's still, not a lot of certainty about what the rest of the economic indicators are going to look like outside of retail sales and unemployment insurance. We're not alone. And this is the one that Leslie calls the gussied up guesses. Because if you look at like the second quarter forecast for real GDP growth as an example, we have everything in here from less than a 10% decline all the way up to a 50% decline. And these are all reputable forecasters, right? The 50% comes out of the St. Louis Fed. So these aren't some crackpots with a tinfoil hat in their mom's basement making these calls. They are legitimate forecasters. But I think the main takeaway is just how much uncertainty there is. And largely that hinges on our predictions for how long we're going to have to shelter in place. And I think that timing is everything. Luckily, the Fed is out in force, providing liquidity, lowering rates. We've seen the federal government throw $2 trillion at this and likely going to need more, but at least a good first step that shows that they're taking it seriously. But it's important for us to remember, right? This is an external shock. This too shall pass. When you look at other outbreaks, which are nothing on the scale of the one that we're currently dealing with, but you could see that for the most part, pandemics resolve themselves over a period of months, not years. Even man-made disasters like Fukushima, we're talking about months in terms of the recovery process, not years. So there is big, deep impacts to the economic environment, and it does take us a while to get back, but in 6 to 8 months' time, we're kind of back at pre-crisis levels. This one's obviously much deeper, but it's helpful to get a sense of how to think through the impacts. And we have done a good job of flattening the curve. So if you go back even to the end of March, we were still projected, if you throw in the confident or the margin of errors, not in terms of our overall hospital capacity. So the purple stuff is below the purple line, even when you factor in the margin of error. But ICU beds and ventilators, the margin of error took us actually beyond our capacity. And more importantly, if you look at the right-hand tail of this bell curve, that we weren't looking at getting back towards something that was more manageable or quote unquote normal until early to mid June. If you look at the updated projections from late last week, or early last week, rather, sorry, you can see that we have done a good job of flattening the curve and that going hard early has worked for us in the same way that it's worked for Hong Kong and some of these other places that have been more successful in flattening the curve. And now we're looking at something that is more quote unquote manageable or normal by early to mid May instead of early to mid June. And so, again, timing is everything when we are trying to think through just exactly how deep the recession is going to be, and how quickly we're able to recover. The timing again can't be overstated, and you can see how much you benefit by going hard early. The big thing that I worry about is that and this was before those new flattened curve numbers came out. But what you could see was that, when you social distance for as long as you need to, you really reduce the amount of cases by up to as much as tenfold, which is critical for thinking about the economic impacts. It's also critical just again from a timing standpoint, because if we're still sheltering in place in October, November, December, that's a much different proposition for businesses being able to hang on, being able to bring jobs back. A lot of businesses just won't survive, which means that a lot of those jobs won't be able to bounce back the way that they could, regardless of how much kind of federal assistance we throw at people. So again, timing is everything. I think if we can, just really eat the peas or take our medicine or whatever and get this behind us quickly, then we can have a recovery that looks more like a Hurricane Katrina than it does like a 2008 financial crisis. So in Hurricane Katrina times, we had this kind of explosion of unemployment that happened overnight, but over a period of 6 to 8 months, we were able to chip that back down towards normal as things got into a recovery mode. But again, if we're still dealing with this, 8 to 10 months from now, that's a much different proposition for the recovery. So I know I've gone on and almost used the whole hour, but I'll just reiterate that we were in good shape economically before this thing happened, and it's a lot different than what we saw in 2008 because we don't have this over leveraged population base and all these deep seated fundamental problems in the economy. But this has really changed what was a relatively rosy outlook for 2020 in a very severe way. And although it's too early to tell on most of these major economic indicators, what we can see in terms of consumer spending and unemployment tells us that the negative impacts are going to be very real, and that we should be prepared for a belt tightening mode. And in fact, what I showed you in terms of realtor sentiment, and I actually observed data on the MLS through yesterday, that we're already seeing that in housing. And so again, the key question is just how long this stuff lasts. And I think that, from my standpoint, the more severe we can make it on ourselves over the short run means the quicker we can start to get back towards something that, might not be the normal of days gone by, but looks more like the new normal, where at least there's economic activity happening. And so again, just taking that medicine is probably just what the doctor ordered from a recovery standpoint. C.A.R. has your back in so many ways, and just really proud to work there. And we have lots of information and also just resources and people who are there on the phones waiting to connect you with all this great federal assistance that you might have access to, and all the other stuff. So again, you'll have these slides to take home, and you can also download them off my website if we don't get them to Annette quick enough, but I will send them as soon as I log off here. But I just want to say thanks to Brian and Ben and Annette and everybody for letting me join you today, and just hope that was helpful. This too shall pass, and we'll all get through this together.
Perfect. Well, Jordan, we want to first thank you for your time. Amazing information. I know it was very helpful for all the members and leadership at
Awesome.
EVAR. So first, thank you for that. We'd like to take this time to open it up to questions.
Awesome.
At this time. So for those that haven't asked a question on Zoom meeting before, if you take your mouse and you hover over the bottom of your screen, you'll see a chat feature. And basically you can type in your questions there. And Annette and I are fielding them from the side, so it might take me a minute to scroll through and find your question and ask it, because it tends to get quick in the beginning. One of the questions that had come in earlier is Jordan, what do you think the recovery period could possibly be for Riverside, San Bernardino County area, being very large counties?
Yeah, definitely. Very large counties. There's also, in Riverside and parts of Riverside, and I know it's true in the desert, but also like in Temecula, Murrieta area where my brother lives is, there's also a huge retail component, like an oversized retail component. And again, those are the kind of parts of the economy that are going to be most impacted. But I also think that, in a former life when I was in consulting, I used to be the economist for the UCR forecast center, so I've always been bullish on the Inland Empire, and I think that it's got the relative affordability and the quality of life that people are looking for. And the only reason why people were still paying so much money to live on the coast was because of the jobs question, right? Is that was just where some of these bigger companies were, and you had no choice. Like I know me personally as an economist, I grew up in San Diego, and I was always like, why would anyone ever live in LA, right? Well, that was a luxury attitude that I could afford when I wasn't actually seeking employment. And so as an economist, there was nowhere else to go. But I think that this has potentially really permanently changed that dynamic. And I think, I'm very bullish on housing moving forward, and for the Inland Empire in particular, because of that relative affordability and bigger lots and newer homes and quality of life and better schools, all that stuff. And so I think that, if I was, and actually paradoxically, when I was taking this job 5 years ago or 4 years ago, I was also interviewing to be the director of research for CBRE. And man, I am so glad I'm here at C.A.R. because I think the outlook for office space and office brokers is permanently impacted by this. And I'm not as bullish on office space, but I think that's kind of the long way of getting around to saying that's why I think both housing is going to be a bright spot in general, because we're all spending more time at home and care about our house more and potentially don't have to make those crazy commutes. And also, why I think that the Inland Empire in particular is going to do really well.
Mm-hmm. Fantastic. And we do think another question to come in is, do you believe there'll be an inflationary period after the dust settles, and what that might look like?
I hope not. If you look back to, and I'm assuming this is related to all the kind of stimulus that's getting pumped in to the economy by the Fed and by all this deficit and debt spending. So I have 2 points on that, why I'm not, the moral of the story is I'm not that worried about inflation at this point. With 22 million people unemployed, inflation is kind of the furthest thing from my mind at this point in time. But the other thing I would point out is that, and I can show you guys some of the stuff if you want to email me later, but the vast majority of the stimulus last time around in 2008 didn't ever make it out onto the street. It sat in the banks in the form of excess reserves, and it was really there as a backstop to the banking system. And you're seeing already that same exact trend play out. So if you look at the money supply, it shot up, crazy over the past couple of weeks. But if you actually strip out excess reserves that are just sitting at banks, it actually doesn't look very different from where it looked at the end of February. And B, the Fed did a good job of clawing that back over time so that, it never ended up as M2 and in people's bank accounts and in this real inflationary thing. On the fiscal side, Econ 101 tells us that huge deficits that are bigger than annual GDP and debts, that are obviously bigger than a year's worth of GDP are not good, and that eventually the bond market will, demand its pound of flesh on that.
Right.
But, the U.S. is still the kind of safe haven and the reserve currency for the rest of the world. And when you look out across the rest of the world, the U.S. is kind of like the cleanest dirty shirt in the hamper. We've got our fiscal issues, no doubt, but the rest of the world is also a basket case. And so, at least over the short run, the next 3, 4, 5 years, that gives us plenty of time to claw back some of that stuff and to get our fiscal house in order, hopefully, when the economy starts growing, although that is a political question, which makes it much more difficult to forecast. It's one of the easiest economic questions, right? This is simple arithmetic. We made this amount of money, we spent this amount of money, but it's also one of the most challenging obstacles politically. But I think that, short answer is I'm not that worried about inflation, because if we, put aside all that garbage and really focus on the fundamentals, it's basic procedure to unwind some of that stuff.
Yeah, absolutely. And another question kind of tied into that, one of the questions came in is, where do you see, or how do you feel about this? The question was a stair-step approach to the house. Would that delay the housing recovery, meaning, opening up the state slowly? How do you see all of that playing out
I think
over time?
Yeah, I think it's a question of consumer confidence. I mean, luckily we live now in a period in time where we have technology and there are ways, and you know, even when it comes to showings and stuff like that with virtual tours, or if it's vacant, and I think that the rules will be relaxed where, like, if you're a seller and you can have one, you know, set of people in your property at a time and you just disinfect it, get out, let them look at it. It's more like scheduled showings and things like that, instead of, you know, just mass open houses with, like, you know, cheese platters and 30 people in there at one time. I think that that's how we can do it. One of the things that we've seen, and I think, again, just going back to how much time we're spending in our homes, like, the benefits of home ownership and the desire to become homeowners has not been impacted. If anything, I think that the desire for home ownership is stronger now that we're all, like, you know, getting cabin fever and like, man, I need my own space to where I can go and just shut the door and be on my computer, and all of that stuff. And so I think that we have technology that we can use. And I think that as once we're past the uncertainty part, even if the state's still in social distancing and all of that, people will feel comfortable moving forward. Like, hey, I got my job, rates are super low, it looks like this thing's behind us. Yeah, we can't go out and shop and do all that stuff, but, you know, I'm gonna take advantage. And I try and, you know, advise people to channel their inner Ira Levine when they're talking to customers and remind them about this kind of 12.5% mortgage rate that my dad used to brag about. I mean, it is like they're almost giving the money away once you factor in inflation. And so I think that, you know, housing will be one of the things that benefits from that will hopefully lead the recovery. But I also don't want to sugarcoat it, because I do think that it's going to be you know, I don't think that they're going to snap right back by 50% the second that the shelter in place has been lifted.
Yeah, and there's another question coming in. I kind of want to expand on it too. Is the second housing market? You know, what would you expect for the Lake Arrowhead, Big Bear area, people who own second homes? And I kind of want to add to that is that, you know, everybody's in a different place in their life financially and age range. That if you own a second home that's not rental income, it's not an investment property in that way, it's just your second home. In the stock market, those individuals have, you know, some may have lost a significant amount of money in the stock market, yet they hold these assets. So the initial question is, what do you think about the second home market in these resort type communities?
Yeah, I think that they're still going to be popular, especially if you expect the financial market to be all over the map. I also think that, you know, people might go into vacation rentals and stuff like that even, right? Just because, again, real estate is a more safe hedge. And you know, similarly on that note, it's not just the retirees buying second homes and stuff, or, you know, wealthy individuals buying vacation properties. I think that you'll also see maybe people step up and help the younger generations a little bit more. It's like, look, it's not doing me any good in the stock market, so A, I'm going to buy myself that vacation property that I always wanted, and B, I'm going to give my kids a down payment so they can get on the thing, because, again, you know, the money's not doing any good just sitting in the bank account or just sitting in the stock market where I could potentially lose it. So I think that the vacation market looks good. I also think just straight up rental property looks good, right? Because unfortunately, with 22 million people unemployed, some people are going to, you know, home ownership is not going to be an option over the near term. And that means that the rental market looks pretty strong coming out of this too.
Mm-hmm. Okay. This question's rather long, so I'm just gonna read it word for word. And it says, in terms of sellers, do you think pre-COVID that we have hit the top of the market? If so, should we have anticipated a decline in pricing? The challenge is unknown of the next few months, and it would seem prices would naturally come down given the lower demand post-COVID.
Yeah, we do see prices coming down a little bit, and I didn't mean to dismiss the idea that prices would be softer, but what we're expecting on the price front is, you know, single digit price movements, not 10 or 20 or even 15%, like we saw last time around, and that goes back to the pre-COVID housing market, right? If you take a look at the fundamentals of the housing market, and I showed you those jobs numbers, we have 2.1 million more people employed, you know, than we had at any other point in modern history. And we had a fundamental lack of housing for those people. And so, you know, as long as we have this economy that was churning out good jobs and not enough homes to go around, that means upward pressure on home prices. Homes just become a commodity, right? And they go to the highest bidder. Part of the demand side has been removed, right, by this crisis. And so we do expect price softness. But what we had last time was, the demand side stepped back when unemployment went through, and then we had all of the kind of bad debt that really just compounded things and created the snowball effect that drove prices so much lower. So right now we're only really looking at that kind of first component of the downturn. We're like, yes, there's certain people who've lost their jobs and income, and those homes are, or their prospects for housing are diminished, but we don't have all these other people who have 5/1 option arms and their payment's going to double overnight as the negative amortization builds up and they weren't on stated income and all this stuff, and they just make the decision like, look, I'm going to walk away from this home because my credit score is going to recover faster than my home price will. That whole element, which is really what took us from 5 to 8% price declines up to the 50% that we saw, just that element isn't there in the underlying economy anymore.
Mm-hmm.
The prices will probably go down because demand is down, no doubt. But it just doesn't seem to me that, with that lack of real fundamental issues under the surface, that we get to anything even remotely similar to what we saw in 2008. That being said, if this thing goes on and on and on, and we are still sheltering in place in October, then I think, demand has been really fundamentally changed, and then we do have bigger concerns on the price front. But I think as long as it shapes up the way that it looks now, where by early summer-ish, right, that we can at least start to resume some activity, even if it's not quote-unquote normal, but people are able to go out and buy stuff and maybe even, eat at a restaurant with masks or something, then I think that we'll hold up relatively well on a price front.
Okay, perfect. I don't, unless Annette, you see other questions coming in, I don't see any more in the chat unless I have missed them. And let me look at this real quick. See if there's one more. Okay. I don't see any more questions for you, Jordan. And Annette, did you have anything come through on your side that I may have missed?
No, we're good.
We're good.
That was the last question that I had seen.
Perfect. Well, Jordan, we want to thank you on behalf of the leadership team at EVAR and all the members that you're so helping us with this information. We truly are grateful for your time, and thank you for spending the last hour and 10 minutes with us.
Yeah, thank you guys so much for having me, and thanks to Annette. I'll send my slide deck out so that you guys have all this data at your fingertips, and just here if you guys need anything. And until then, I guess we'll see you on the next one.
All right. Thank you. Thank you so much.
Thank you all.
Last thing for the group, the video has been recorded, so that'll go out along with the slide deck by Friday. So all Realtor members will receive that. Have a great day.
Perfect. Thank you.